For many years, the relationship between the United States and its global competitors, especially Russia and China, has become increasingly tense. Recently, due to the ongoing conflict in Ukraine and the escalating trade frictions between China and the United States, these relations have further deteriorated and reached new highs. Against this background, in May 2024, Russia reached an agreement with China during a visit to China to stop using the US dollar for settlement in bilateral trade. So, what impact will this decision have? Can the US dollar continue to maintain its global currency hegemony? In recent years, in the face of economic recession and financial market volatility, the Federal Reserve has implemented a series of monetary easing policies to promote economic growth. These policies mainly include keeping interest rates at historical lows and implementing quantitative easing measures to inject a large amount of funds into the market. In the short term, these measures have indeed supported the US economy to a certain extent, but in the long run, this continuous capital injection has triggered a series of side effects and risks. First, the Fed's continuous easing policy has further exacerbated global inflationary pressures. Excess liquidity has led to widespread price increases, and signs of bubbles have appeared in the stock market, bond market, and housing market. More seriously, these bubbles have had a significant negative impact on emerging market countries with relatively fragile economic systems. Take Vietnam as an example. As an emerging market country, it faces great challenges under the influence of the Fed's loose monetary policy. The increased liquidity of global capital has led to a large influx of foreign capital seeking higher returns, which has pushed up local prices to a certain extent. Although Vietnam's economy has benefited from the influx of external capital, these funds may flow out quickly against the backdrop of the Fed's tight monetary policy, creating the risk of capital shortages, currency depreciation, and even financial crises. Therefore, as the Fed's policy continues to ease, global market concerns about such phenomena are also increasing. Emerging market countries such as Vietnam may be harmed by the adjustment of the US economic strategy. This situation is not only in Vietnam, but also in India, Japan, and South Korea, where major currencies such as the yen and the won are facing depreciation pressure. Analysts believe that the United States uses the dollar as a means to divert domestic economic difficulties while also taking the opportunity to benefit from the economies of other countries. As a result, many countries have begun to explore strategies to reduce their dependence on the US dollar, among which China and Russia's strategies are particularly eye-catching. The two countries are not only strengthening their bilateral trade relations, but are also committed to opening up new trade routes, such as cross-border economic corridors, which may pose a challenge to traditional trade and supply chains based on the US dollar. The Belt and Road Initiative promoted by China has been responded to by 140 countries or regions around the world, covering nearly 40% of the world's trade volume. Today, China and Russia have strengthened their strategies to de-dollarize. On May 16, 2024, Russian President Vladimir Putin paid an important visit to China. During the visit to China, the leaders of the two countries jointly issued a joint statement, planning to comprehensively expand the scale of trade and optimize the trade structure in the new era, increase the proportion of local currencies used in bilateral economic activities, strengthen the construction of financial infrastructure between the two countries, and smooth the settlement channels between enterprises of the two countries. So, what impact will this decision bring? It is understood that Russia was previously forced to break away from the US dollar settlement system and switch to local currency settlement with China and other countries, which has led to up to 90% of bilateral trade between China and Russia being conducted in local currency. With the increase in local currency settlement, the two countries will cooperate more closely in energy trade such as oil and natural gas. This will not only help meet the energy needs of both sides, but also provide strong support for the sustainable development of the economies of the two countries. In addition, China and Russia will reduce their dependence on the US dollar and reduce the impact of exchange rate fluctuations on trade, thereby enhancing the stability and sustainability of bilateral trade. The strengthening of the financial infrastructure of the two countries and the unblocking of settlement channels will provide more convenient and efficient financial services for cooperation between enterprises of the two countries, further promoting the development of bilateral trade. Over time, other countries have also begun to follow this model, making the use of RMB in global economic and trade activities increasingly common. As of June 2024, the RMB has risen to fourth place in global payment currencies, with a usage ratio of 4.7%. Although the US dollar and the euro still occupy the leading position, the rapid growth of the RMB has posed a threat to their status. At the same time, China has reduced its holdings of US Treasury bonds for 3 consecutive months, with a total reduction of $549.3 billion, a significant change compared to the peak in 2013. So, can the US dollar continue to maintain its global currency hegemony? Although the US dollar remains the world's preferred trading currency and has unparalleled advantages, its hegemony is facing unprecedented challenges. These challenges come not only from international competition, but also from the US's internal economic policies. The dollar's ability to become the world's dominant currency relies heavily on the deep trust of the global market. However, long-term fiscal deficits and excessive spending are gradually eroding this trust. At present, the total US national debt has climbed to a staggering $35 trillion. This huge figure has not only shocked the world, but also caused widespread doubts about the US's ability to repay its debts. The international community's trust in the US dollar has cracked, and this crack seems to be gradually widening. Recently, the US Department of Labor released the CPI data for April. Compared with previous months, the CPI growth in April was in line with market expectations and did not rise beyond expectations. This suggests that under political pressure, the Federal Reserve may be considering ending the current interest rate hike cycle and may even start to cut interest rates before the end of the year to stimulate the economy. This policy adjustment is closely related to the presidential election cycle. Historically, the United States usually adopts loose monetary policies in election years to increase the economic welfare of the people. Although the current President Biden cannot directly pressure the Fed like some presidents in history, the Democratic Party's pressure on the Fed is expected to continue to increase in the context of fighting against a powerful opponent Trump and facing an unstable election situation. If the Fed does adopt an easing policy, the US dollar is expected to face depreciation pressure in the second half of the year. Furthermore, if the BRICS countries led by China and Russia launch an independent settlement system to accelerate the process of de-dollarization, the US dollar in circulation may experience a sharp expansion, thereby accelerating the depreciation of the US dollar. In this case, the financial nuclear bomb that the United States has long used as an international pressure tool may eventually have a significant impact on itself. At the same time, as China's economy continues to grow and the global financial market's recognition of the RMB increases, the role of the RMB as a potential alternative currency in the international monetary system is expected to increase in the future, and it may even replace the position of the US dollar.